All right, so chapter 10, current liabilities and payroll. The reason we're going to take a look at this here, remember I showed you a little bit about liabilities and things like that when things come halfway between in the month and different things like that at the end. So we'll take a look at that again. And then basically let's pull out a payroll, those type of things. So we'll try to illustrate the current liabilities, the accounts receivable, the portions of that, what portions are long-term, what's not, and those type of things there. And then we're going to determine employer liabilities for payroll, because you aren't the only one who pays taxes on payroll. They don't show everything, some of them don't show everything, but the employer pays quite a bit of taxes also as a part of it too. So not just yours, as they hold, but they also pay a portion too. So determine employer liabilities for payroll, include liabilities arising from employee earnings and deductions from earnings. And then describe the payroll accounting system and use a payroll register and those type of things. We're not going to go, like I said, a lot into this because it's not a payroll class, but we'll kind of look at some of the things, and I'll probably move through it pretty quick, but we'll take a look at some of the things that we have here. All right, I may have to get closer and closer than over here. Journalize the entries for employee fringe benefits, including vacation time and pensions, because we need to make sure we put that aside there. And then obviously the pensions. So as you move it on further in accounting, you do a lot more. So we'll talk about pensions. I'm going to describe the accounting treatment for contingent liabilities. So for part employment, warranties, and those type of things. We're not going to go into a lot of details on that. You do that in other aspects of accounting. We'll go a little deeper into it. We'll just kind of let you know what it's all about. Describe and illustrate the use of quick ratio in analyzing the company's ability to pay current liabilities. We kind of looked at that already, with the working capital and the quick ratio. The one thing that we'll take out that I'll show you that in a few minutes, the inventory there. So we'll take a look at that. All right. So let's take a look here at liabilities. So when a company or a bank advances credit is making a loan, obviously. So making a loan, the bank or company is called a creditor or lender, which makes sense. We all know that from our personal experiences. And then the individuals and companies receiving the loans are called debitors or borrowers. Should be pretty easy. Long-term liabilities are to debits beyond 1 year, which we already talked about way back in chapter 4. Yeah, chapter 4, and then we talked briefly about it in 1. Current liabilities are debts that will be paid out of the current assets that are due within 1 year. So within 1 year. Current liabilities long term is more than 1 year. So accounts payable transactions arise from purchasing goods or services for use in the company's operation, or they're purchasing merchandise for resale. All right, yeah. So in here, we look at some companies, some other companies that we looked at before with their fixed assets. You can see accounts payable as a percentage of the current liabilities. It's pretty high for a lot of them. And a lot of them is because they may be selling things as a part of it. So like Rite Aid, they're selling goods and services, goods that they may have, services and goods. Chevron for their oil for the gas and stuff like that they have. So a lot of other things there. All right, so long-term liabilities are often paid in periodic payments, so we may do it over installment times. And so sometimes that could be once a year, twice a year, every month, just depends. And so it must be classified as current liabilities, the ones that are going to be paid this year. Why? Well, they're going to be currently paid the next year, so that's why. So those installments due after the coming year are classified in the long-term liabilities portion of that. So in here, Nature's Sunshine Company issues a 90-day 12% note for $1,000 dated on August 1st. To Murray Company, $1,000 overdue on the account. Remember we just looked at this from last chapter 8, I think it was, just a little bit ago. So accounts payable, we move it over to, or we take it out of there, excuse me, and then move it over into notes payable. So we now have a note that they owe us. But that's still, that note is a short-term note, right? Because it's 90 days. So we're not going to be a long term. So when the note matures, the entry to the record all this, like we looked at before, we get rid of the notes payable, we have interest expense, and then cash. It's covered up. All right. So the short-term notes payable here, on May 1st, Baldwin Company purchased and merchandise on account from Coker Company for $10,000. And these are the terms that we have. The merchandise cost Coker $7,500. So as we take a look at this here, merchandise inventory, remove all that stuff, bring it all back that we had before. Merchandise inventory, $10,000, $10,000 for accounts payable. That's our asset, that's our liability. And then here, on the other side of that, now we have somebody owing us some money. And we have sales, $10,000. Now the cost of merchandise sold, here, and the merchandise inventory taken out of my asset, because I got rid of it, and that's what it cost me, and that's what it cost of merchandise sold. Just going back to what we had before. So the Baldwin Company issued a 60-day 12% note for $10,000 to Coker on the account. So as a part of that, then we get rid of our accounts payable, and now moving on to notes payable. So that's why we back that out of there. And then we have notes receivable. It's our asset, and we removed our notes receivable. Our accounts receivable was our asset, so we removed that. All right, short-term note payable here, another one here, amount due on May 31st. The face amount is $10,000 plus interest of $200. That's how they figured it out there. It's 2 months, 1% a month. So this is how we have it. So we had notes payable. We're now debiting that, which means we are getting rid of that. We have interest expense, and then we have a cash outlay of $10,200. So we're moving our asset there, and we've also increased our interest expense. And on this side, we get that cash in. So that's our cash, $10,200. Interest revenue, additional revenue that we have, and our notes receivable now is removed because now they have paid their debt to us. On December 19th, the company borrowed cash from First National Bank by issuing a 4,000 90-day 15% note. So a little different here. So we have 15%. Okay, so we have cash that we get in from that. They issued it to us. And then we have a note that we're obligated to pay. So December 18th, Iceberg Company paid First National Bank the $4,000 plus the interest of $150, which is the 15% for 3 months. So as a part of that, we have our notes payable again. We remove that. Interest expenses increased because now we're paying that. And then we have a cash outlay of $41.50 because we have to pay all of that back. So hopefully we've done some good things with that $4,000 over that 90 days. And we use it efficiently. All right, the discount note has the following characteristics. So now there may be a discount note that you get. So the interest rate on the note is called discount rate. So you'll see that. And the amount of interest on the note, called the discount, is compiled by multiplying the discount rate times the face amount of the note. We'll kind of walk through what this all means in just a second here. And the borrower receives the face amount of the note less the discount, all the proceeds. Okay. So basically this $5,000 note, but I will receive maybe only $4,800 because $200 there is going to be my interest in that type of stuff. That's the discount there. So we'll take a look at what that means. So the debitor must pay the face amount of the note on the due date. So I have the $5,000, even though they only give me $4,800, because the other was for that interest that I was going to do. So that's what that's in essence. So let's take a look at what that means here. So on August 10th, the Carrier Company issued a $20,000 90-day discounted note on Western National Bank. The discount rate is 15%, and the amount of the discount is $750. So we basically get that 3 months, 50%, $20,000. So cash here, that's what we're receiving because we have the interest expense, and so that's the notes payable. So that is what we owe is the $20,000. So when we do the transaction again, the next transaction, we will pay back the $20,000. So we'll debit notes payable and cash $20,000 credits. But we only receive that much in cash. So that's our proceeds. That's what we get. So what I was saying there, as you know, it's payable for $20,000 and then cash outlay for $20,000 because that's what we owed, even though we only received $19,000 some change. expense or interest. All right, questions? All right, so now we're going to determine the payroll liability. The liabilities rising from employee earnings and deductions from earnings. So there's liabilities there. Even though we're collecting it because the employee owes that portion of it, and we pay that portion, but we also own our own portion of that. So in accounting, payroll refers to the amount paid to employees for services they provided during the period. The company's payroll is important for the following reasons. Well, if we don't pay it, we're just sitting around. But payroll and related tax, payroll taxes significantly affect the net income of most companies. It's a huge portion of it. Sometimes a third, sometimes maybe a half, maybe even more than that, depending on if you're a service company. It could be considerably more. So it just depends. Payroll is subject to federal and state regulations. If you don't follow the federal and state regulations, you're not going to be around, because they'll come in and close you down quickly because they want to make sure they get their piece. And so if you're not following the regulations correctly, that could be a big problem. And good employees morale obviously requires payroll to be timed and accurately. You don't want to not be paid at one time because you have bills to pay, right? You all know that real well. We want to make sure we get our payment when it needs to be there. So salary usually refers to payment for managerial or administrative services. Salary is normally expressed in terms of month or a year. So you have that broken down, which then it can be broken down even into weeks if you need to, but that's the way it usually is done. So wages usually refers to the payment of employees' manual labor. So the rate of wages is normally stated in hours or a weekly basis. So that's the way it typically is stated there. So basic stuff, this should be pretty easy for you because we've all worked, we've all had jobs, and so we're probably used to seeing a lot of this stuff. So I'm just going to breeze through a lot of this pretty quickly. So the employed by McDermott Supply, the rate of 34 an hour plus 1.5 times for overtime, over 40 hours per week. One of the things you will want to notice here is that some states are different. So some states, I remember in California at one point, if you went over 8 hours, you were considered overtime. Then they changed it to the 40 hours. And it's changed. So some states are a little different depending on how they're set up. So it could be 40 hours a week, or is it 8 hours? And a lot of them are going to 40 hours just because, especially for the healthcare field, a lot of them work 12 hours a day. Because a lot of them are 12-hour shifts. So a lot of them are that way, but just be aware that different states have different requirements. So we work 42 hours, we have 2 hours of overtime. So here's our 2 hours of overtime, because it's time and a half. So it's $51 the rate. So 2 times that gives me my overtime, and the regular rate is there. Just like this with my total earnings. Pretty simple stuff. Probably seen that quite a bit. So total earnings for an employee for a payroll period, including any overtime, is called their gross pay. That's what you have as your gross pay, which you should get, but before people take their cuts. So from this amount is subtracted one or more deductions. So there may be some of those things that are taken out of your deductions, and it may be some of your own deductions that you have. Maybe it's health insurance, retirement, all those types of things come out there. So in your withholding certificate here, this is where you select how much you're going to have withheld. And so depending on what you want, you can get back. It depends also on what they pull out. If you don't pull out enough, you could then owe a lot. And just be aware that if you don't pull out enough, there could be penalties too, if you're way outside of the way you're supposed to be. So just be aware of that, because the federal government wants their money, and so we must make sure that they must be within a reasonable set of area there. So this is what this person made for the week. This is so claim one withholding, which is $70 plus the wages. You should determine that withholding. They fall into a certain bracket. And so this is the brackets that they would fall into. So they can look at it, figure out where it is. Now most of this done, that's the way we used to do things, is look at all the brackets. Computers figure all this stuff out for us, because we can figure just basically put it in, and it figures it out. So basically it's $91.40 plus 25%. And that's what would be withheld. So it's in that area there. So FICA, my favorite. Federal Insurance Contribution Act, with the following 2 programs here. Social Security. So Social Security provides payments for retirees and survivors of municipal insurance, assumes 6% on all earnings there. Up to we'll talk about certain points. We'll talk about where that stops at just a little bit here. And some of this may be dated a little bit. This used to be 6.2, but it's gone down to 6.0, and then so I have to look at what it is now, but it may have changed a little bit. And then Medicare, which is not Medicare anymore, it's the health insurance, HI, you'll see that as now. So, which assumes a 1.5% on all earnings there, which is now a little bit more, I believe. I can't remember the number, but it's a little different. Well, let's just use this information for calculation purposes. All right, here, so we have earnings subject to the 6% Social Security tax. All of your amount is, until you reach a certain amount. And that, we'll take a look at that. I think that comes up in a few slides here. And that may have also changed too, but it varies. So once you hit a certain plateau, you stop paying Social Security. So a little bit over $100,000, usually about 110, that area, you stop paying Social Security. But your tax bracket's a lot higher too. And so, because the reason they're doing that is you're not going to get the benefit at the end time out of Social Security either. So here's your rate there, 6%. And so you have $87.72 going to that. Then you have your Medicare tax, which is on all of that there. So it's $21.94. And that gives me a total FICA of $109.95. All right. And so these are all the breakdowns of what you have here. And so out of all that, 1462, pull out $400. This looks like a paycheck. You've probably seen a lot of this before. This was retirement savings they went into. They had United Fund, they put in some other money in there. But you've probably seen a lot of things like that too. And then you have probably health insurance on top of that. So one of the things I want to, just on a side, retirement savings, please, 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 if your company offers you retirement, take what they give you. Take it. It's free money. Take the money. Take it. So if they offer to match you up to 3%, put 3% in your retirement. They're giving you 3% too. So make sure you take advantage of that, because that's a nice bonus. And 3% won't hurt you that much, or 6% it's not as bad. But it's nice to be able to get that contribution that they put in there for you. They're trying to help you towards your retirement, so just be aware of that. So I'm going to move off of that now and talk a little more about the liability for employers' payroll taxes. So are subject to the following payroll taxes and amounts paid for their employer, employee's FICA tax, the federal unemployment compensation, which is FUTA. We have SUTA. So we have both FUTA and SUTA. The company is the one that pays this, and there's a certain point to where they pay it at. So then they stop paying it. And it depends, the states are a little different for theirs. And we'll talk about federal. So states have different setups for each state on how much they pull out. And a lot of it depends on how much they're paying on unemployment, because they need to make sure they're covering what's coming in from what's going out. So they're making sure that they have everything there. So, but just be aware, it's usually at a set point, and then they stop paying that. So it could be at $7,000. Yeah, first $7,000 that every employee makes, they may pay a percentage of that. After that, they don't pay anymore. What that does, and we'll talk about it here, I don't know that they talk about it, but I'll talk about it a little bit, is that it provides an opportunity for the people, the companies to keep their employees. Because if you're turning over employees, you're paying that each time for that unemployment, right? If you're letting go of employees, and then you have claims against you on top of that too, and then every $7,000 you're paying on that unemployment for that first $7,000. So really, we wanted to promote the companies to keep their employees, train their employees, and continue to keep them. That way they don't have to pay as much taxes on that too. So that's kind of why it's the way it's set up. I don't know if we'll go through that or not here. So the employee and government visit how this all works in the tax payments here. So that's about all we have on that. So those are just some basic things. I don't go into a lot of detail on this one. If you take a payroll class, you go into very, very detail on everything that's pulled out and everything that goes with it. So now we're talking about the systems used in the county register, employee earnings and that type of stuff. So payroll systems should be designed to basically make sure, and a lot of companies outsource this, that they may do. Some keep it internally, but pay employees accurately and timely, obviously that's very, very important. Meet regulatory requirements for state, local, federal agencies that they have. provide useful data for management decision-making needs. Obviously, we want to make sure we have good ideas of what's happening here. And a lot of it is those type of things. Remember, all of our accounting information systems need to help us make decisions. So that's why we set up a lot of those things there. So payroll register is a multi-column report used to summarize the data from each payroll period. So we'll take a look at what a government supply company here. So basically, just breaks down everything here. These are total hours worked, regular, then you have your overtime and all those things there. And if I'm a leader, I'm looking at this column and seeing what's going on here. I don't want my people working a lot of overtime unless it's needed. If we have to, we have to. We just gotta get it, we gotta get the stuff done. But if there's ways to not have this, we should find ways of not having that. So this is continued on, because this is a long spreadsheet here. And so this is their Social Security tax. We're keeping all this information in here and all of this compiled, and these go into special accounts for all those things. So sometimes when you see your company takes out for your retirement, you go, why isn't it in my retirement account yet? Because they don't put it into a certain time, well, in the middle of the month maybe, or whatever it may be. So that's when they usually put that and deposit those things and pull them out of theirs and put it into your retirement accounts. But they put it into this holding, and then they pay it when they're supposed to pay the federal taxes and the Medicare taxes and those type of things there. And so in this, you see what the net pay is, the check number, and then where the accounts are going, where this is coming out. These are sales team, this is our office, so we know where we're spending our money. So in here, this is a journal entry. A lot more complicated than stuff we've seen before, but basically the same sort of deal. Basically, this is sales salaries expense and office salaries expense. They all go to that. These are all the things that go into that there. All those things are feeding those expenses there. So we have 2 debits, it looks like 6 credits, but they all equal. So employers must match the employee's Social Security. So remember that. They must match your Social Security. So there's a portion of all that is matched as a part of what's put in there. So whenever we put in Social Security, the company matches. So that's why if you're an independent contractor, or you basically have your own business, you have to then pay both sides of that. So when you do your self-employment tax and it goes, wow, this is a lot higher than regular, because you're paying both the employee and the employer. And that's why it's a little more. So just be aware of that. So like 12% you're paying on it. So just be aware of your owning your own company, small companies, that may be the case, and that's why. And so this is how we would compute it here. So there's our Social Security tax, Medicare, SUDA, and FUTA. And again, the company pays this. The employee does not. Questions? All right. And so this is a journal entry with all that information into here. This is our payroll tax expense, and all these things go into that. All right. So a detailed payroll record must be kept for each employee. This record is called an employee's earnings record. So we must have detailed information on those things there. One of the reasons is we got to do a W-2 at the end of the year. So we must have all that stuff there. So we have all of this information, and then that's what we use to compile all of that information for tax purposes. And so this person here, yeah, not too bad. I love this guy, especially with this $30,000 in overtime. Goodness. Call this company up. So, but they keep track of all that, and then they'll provide that to you in a W-2. And so these are all the deductions. So you can see Social Security here. That's how much was paid into it. Then Medicare, federal income tax, $21,000. Retirements, you only put $1,000 away. I'd probably put a little more in that. That's just me. And then any other, because you may have had union dues or something else that you may have pulled out there. And there we go, on W-2. So that you put that information into your, or take that to your account, to your taxes. Well, nowadays we can do it with the tax or All right, at the end of each payroll period, payroll checks are prepared. Each check includes a detached statement showing details of the payment and stuff like that. And a lot of times now, we don't even, it's not even done that way anymore. I mean, I rarely ever see mine. It's all electronic. We get it direct deposit, we have all this electronically there. So that kind of breaks down everything for you. This has it on electronically for you. So the inputs into a payroll system may be classified as constants, which are data that remains unchanged from payroll to payroll. And then you have some things that do change. Obviously, employee names and social security numbers, and then pay times and stuff like that, hours, basically may change, all those things there. All right, let's take a quick look at a couple of questions here. Get away from looking at all those PowerPoints. All right, let's take a look here. I'm going to walk through a few of the problems here. I want you guys to do on 476 PE 10-1A. Take a look there. Let's look at the question. So on October 12th, Illinois company borrowed cash from Texas Bank by issuing a 30-day note. The face amount is $70,000. So we'll determine the proceeds of the note, assuming the note carries an 6% interest. So what's the proceeds there? $70,000. That's pretty good. All right. We have $70,000 as our proceeds. Next question then asks, well, what is going to be determine the proceeds of the note, assuming the note is discounted at 6%? 65,800. All right, so what we're going to do is we have $70,000, and we're going to take that away from what the discount is here. So we have $70,000. And then we have $70,000 times 112 is 90 days. Or so I'll just take a 30 over 360, which is 112. And then what's the percentage rate on that? 6%. So what do we get there? So what we have here. Right? All right, questions on that one? Okay, I'm going to have us do another one here. I'm going to skip 2, because you guys can probably do that one on your own. So I'm going to do 3A. So PE 3-10-3A. Have we do that one? as you're reading through the problem, remember that what the wages are, take away the value or the federal withholding, and then remember we got Social Security and Medicare as a part of it. And remember, as you're taking Social Security away and Medicare, we're multiplying it against the what we're paying the employee, not after the federal. All right. How we do? Good? You good? All right. No problems there at all. All right, so let's move on to another one then. Let's do 10-4A. Give me a moment to get this down. Just don't put it together. And what you're going to do on this one is journalize some of those things. If you need an example for that one, 10-4A, you can find that on page 459.
I was like looking up and down like.
That's what I was doing. Where did that number come from?
Oh, man.
Oh, he
I
was
knew I
like-
should have waited up. I went for the B problem. What's going on here? I'm just, yeah, it's also bedtime. And that should be, I can't read it very well.
43560.
Why don't you just tell me, what's the salaries payable? 159? 59,940. That look better now?
Those other numbers, I was like, wow, I really messed up.
What did you do? All right, so questions on that one? Seems like everybody's got that pretty well. All right. Let's take a look at a couple more PowerPoint shots here. We'll keep moving through this. All right, so those are some of the things that can be different. All right, so internal controls for payroll systems, some examples of payroll controls include the following. The check signing machine is used, so bank payroll checks and access to the machine should be restricted, obviously, so that people can't get access to that. If that's a misuse. The hiring and firing of employees should be properly authorized and approved in writing. So it's already approved, and typically you want to give them their last check if they're being terminated that day. And actually it's required in some places, 24 hours. All changes in pay rates should be properly authorized also. Employees should be observed when arriving for work to verify the employees are checking in for work. And usually a lot of times they have different things, badges and things like that. Payroll checks should be distributed by someone other than the employee supervisors, and a special payroll bank account should be used. Not all companies do that, but should be that way, especially for those systems, control systems. If you're a publicly traded company, you definitely need to be done this way. But some smaller companies don't do all that. All right, so we're going to drill down some entries for employee fringe benefits, including vacation pay and pensions. We're just going to take a look at these. I'm not going to have us work through too many problems in this area. I think I might have to do one. So many companies provide their employees benefits in addition to salary and wages earned, such as fringe benefits. And they include all some of these things: vacation pay, medical benefits they may provide, retirement benefits they may match, or if they have a pension, they may provide some things into that also, depending on what that is. So in here, we may have accrued, so we may have paid some of this out, and there may be some things that we may have here. So accrued vacation pay for the year. So we have vacation pay payable, and then vacation pay expense. See how costly that could be for the company? So those are some things there we need to be aware of also. That's why some companies they don't provide as much as they do for other countries. They would say we are one of the lowest in a lot of major countries in the world. And pension, was that?
France has a lot of vacation.
Yeah, in France, Germany, a lot of them have them for 6 weeks, or a week, or a lot less than that. Usually average about 2 weeks a year. A pension is the cash payments to retired employees. So pension, now usually one of the things when you talk about this in intermediate accounting too, is that pensions and how they work. The pension is basically owned by the company. They have a responsibility to pay this pension. So those are some of the things there. So it's a defined contribution plan. You are supposed to put in this, you get this out of it, or the company pays this portion, all of it, and they give you this at the end of the time. And they have different ways of calculating that. Years of service by this times that, and your last salary, your last 3 salaries, those type of things. So it could be several different ways. So then you have a defined benefits plan there too. So in a defined contribution plan, the company invests contributions on behalf of the employee in the employee's working years. So normally the employer contributes to the plan. So that's a defined contribution plan. You do this, you do that. The employee's pension depends on the total contributions and the investment returns earned on those. So sometimes what's earned on those things. So it's a little different that way. So the pension is in some ways similar to a 401k, but not. Because ultimately, the company is responsible for their investments and that type of stuff. For our 401ks, we are. It's our choice where we put the money and how we invest it. If it does well, it's our fault. Or if it's great, it's all, if it does bad, it's our fault. So we have to take responsibility on that. This company here contributes 10% of the employee's monthly salary to a 401k. Assuming $50,000 of a monthly salary, the journal entries record this what the contribution is. This is the $50,000, and it's a cash outlay towards that. So we have a pension expense going into that. Now, since it's a 401k plan, that goes into a plan that is not managed by our company, typically. So it's managed by an outside company, and they manage that, which we as employees have access to be able to change those things and change our investments in there. So remember, when you're signing up for your company, they ask you, well, how do you want to invest this? And usually a lot of times you do it by age, how close you are to the retirement age, and that's how they kind of figure out how they want to invest for you. You can change that, you can alter that, those things there, because it's yours that's being put in by the company. In the defined benefits plan, the employer is obligated to pay for the fund's employees' future pension benefits. So they're investing it, and they need to get the money out of that money. So they're the ones housing this money here. So many companies are replacing this benefits plan with a deferred contribution plan, defined contribution plan, because they're not responsible anymore. Especially the problem is they're not getting the returns that they expect. So put it out to the employees to make the decision there. And that way we don't have that obligation. We'll put in the 9-10% for you. That's it. We're done. You handle it from there, and if it goes up, it goes down, it's up to you to handle that. And so that way they don't have that obligation, that huge debt as things go on over time. So a retired employee receives a specific amount based on his or her salary history and years of service, like I was talking about earlier. So that could be here. So we have cash outlay, then unfunded pension liability. So we have to fund more towards it because we need to make sure we have enough in that liability, in that account there, to be able to meet other obligations as months come along. So as post-retirement benefits, employees may earn rights to other post-retirement benefits such as dental care, those type of things, all those things that could be there. Tax services, legal services, there's a lot of different things that could be a part of that. Even including airlines. If you work for an airline long enough, some of them, 10 years, 15 years, you get free flights for life. Some of the things they work out for you. It just depends on each airline, they do different things. And so there's different benefits that they have, tuition assistance and those type of things there. So in here, these are some of the liabilities, just kind of what the balance sheet looks like as a part of that. As you can see, our salaries and wages payables, considerable amount, so it's our payroll taxes, and so are our interest payable. So questions on any of that stuff I just talked about? Now we're going to briefly talk about warranties. Again, you'll talk about this, those are going to accounting. I just briefly touch on these things, talk a lot more detail in intermediate accounting 1 and intermediate accounting 2. We'll talk a little bit about warranties here and how they're treated. So some liabilities may arise from past transactions. So basically a warranty, because we provide, I sell that computer, I expect that, my customer expects that computer to work, but after like 6 months it may die. Well, then I've got an obligation to make sure that works, and the potential obligations, potential liabilities. So there's 2 factors to that: likelihood of it occurring, so probable, reasonable, or relatively possible, or remote. So we've got to figure out how often this is going to happen. What are the chances of this happening? For computers, it's a little higher than just maybe reasonably possible, but there may be a certain amount that may be there. Not really remote, because if we're selling millions of computers, there's good chances that some of those are going to come back. So measurement, estimatable or not estimatable, is how much of it we can estimate there. So what we may have is we may put away some of these things. So during June, a company sold a product for $60,000 that included 36-month warranty for repairs. The average cost of repairs over the warranty is 5% of the sales price. The entry to record the estimated product liability for that. So what we're going to do then is, because it's 5% of that value there, that's where we come up with $3,000. So we put in there a warranty payable. We owe this out there. It's a liability. Now, do we maybe there's an opportunity that we don't pay this? Yeah. But we make sure that our statements show that we do have an obligation out there to potentially have to pay this. And so that's what this is here. This is our product warranty expense, because that's our expense as a part of the sale of that, whatever it was, that product. So if a $200 part is replaced under the warranty as a part of that there, we then reduce our product warranty payable by $200, and then we take off the supplies for that, supplies we use to fix that. So we reduce what we have in the payable because we owe less on that, and then we take away from more supplies because we have less our supplies. All right, so this is kind of how it breaks down. I'll give you a moment to take a look at that. As you see, if it's remote, you really don't put anything in there. Reasonable possible, we disclose the liability. That is a different thing than how we treat it up here. And so that's where we may estimate it if it's probable and put it in there. If it's, we disclose it, that's what we do in our financial statements. Yeah, we may do that in the footer as a note in there. All right, so now let's look at ratios real quick here. So this is pretty simple ratios we'll take a look at, which is the quick ratio. So the quick ratio is something a little different. We've looked at the current ratio before, which is our current assets minus or divided by current liabilities. In the quick ratio, it's just a touch different. So our current position analysis helps creditors evaluate a company's ability to pay its current liabilities. And so it's based on working capital, the excess of the current assets over current liabilities, right? We looked at that in chapters, I think it was 1 and 2, somewhere in that area. And the current ratio determined by dividing the current assets by the current liabilities, which I just said. So that's what that is. Now the quick ratio is a little different. The quick ratio indicates the company's short-term liquidity, how we can get money quickly and pay off our bills. And so in that, we have to take our quick assets over our current liabilities. And so quick assets are cash and other current assets that can easily be converted into cash. We'll take a look at that in just a moment here. So it's quick assets over current liabilities. All right, and they tell you what the quick assets are. That's really good. All right, usually you take away the inventories of that. So that should say that in the book there. I hope it does. So you'll take those out of it. That's typically the one thing that you'll see in there. And most of the problems in the inventories is not aware of that, so you won't have that in there. So questions on that, pretty simple, really easy to figure out. All right, let's take a look at one more problem and we'll get you out of here. So let's take a look at the PE 7-A. Yeah, 7-A. It's just a warranty one.
10.
Yeah,
7.
10. Yeah, 7. Where am I? I tell you what, I get tired. I'm like.
I was like going backwards into chapter 7, wondering why we were doing that.
Yeah, don't worry, really. 10-7A. How's that? It's written right here right now. It's right, I think. Occasionally, we'll be right. That is on page. Yeah, 478. And a good example of that is on page 468. I'll get my numbers correct. Tell you. Wow. They say sleep's not needed.
Who says that?
I don't know. I definitely don't agree with it.
Shot. That's what it means.
We're taking a look at Coca-Cola Company here. The first question is, how much of the long-term debt was disclosed as current liability on the current year's December 31st? Where am I?
That's
I look at the wrong one. Okay, go back, let me read the kind of question here. I'm tired. Okay, I can't even pronounce this company's name. Sold 200,000 of equipment during February under a 1-year warranty. Good job with that. The cost of the repair defects under the warranty is estimated 6% of the sales price. So 6% of that sales price. And then on July, they will do that second part of the transaction there. The good news is the old people that see this video is going to go and be wondering confused with what's going on with me. Yeah. All right. So the first one is basically taking 6% times the 200,000, which gives us 12,000 as a product warranty expense, and then a product warranty payable, $12,000. And then what we have is a claim towards that product warranty. We need to take out supplies for that, $60, and then we have wages payable that were a part of that to fix the problem of $32. So we then debit product warranty payable, $92, and we're taking it away from that there. So we only have $11,908 left.
I did it right.
All right. There you go. All right, so do I have any questions on chapter 10?